Hi everyone, so let's talk about the commodities and the seasonality, and I'm also going to talk about the metals obviously and the currency futures as well. So this video is going to be I think really important if you are looking to get a better understanding of the futures market, the commodities market, and become really a professional trader. So let's begin with what affects seasonality. So really there are just a few things, and it's really not too complicated. And once you get the gist of it, it becomes really common sense. So obviously the weather seasons can affect seasonality. So winter, summer, fall, and so on. Especially the transitions from summer to winter and winter to summer. This is something you really want to kind of keep an eye on. And during these seasons, kind of follow very specific commodities, and we are going to go over every single commodity, so you'll know exactly what's going on for each and every effect of seasonality for it. So holidays are also a big thing. So for example, Thanksgiving and Christmas, during these holidays, the meat commodities, they tend to be more volatile because obviously there's more demand. People just buy more meat to for the Thanksgiving meals and the Christmas meals. So there's usually more volatility during these times. So usually when there's more demand for a commodity, you can expect volatility to go up. Now, I never really know if things will go up or down in price, but what you can expect is volatility to go up. You just don't know in what direction it will go up. That's the only thing. Now, the third thing is the crop harvesting season, and this applies to pretty much only the grains. And it's usually from April to July, and I'll show you exactly what it looks like on the commodity volatility index, so on the CVOL. So you'll be able to see exactly where I derive those, or how I get to these conclusions. And it's really simple because everything I know is just based on experience and common sense, and you'll be able to see that commodities are much more common sense, especially when it comes to seasonality. Now, the definition of seasonality is really simple. Essentially, it's the same events that take place every year around the same time of the year, and excluding obviously reports that commodities have. So essentially, like every year winter will come, right? Like winter will come every year. It might be colder, might be warmer than the previous year, but winter will come, and then obviously you'll have a summer, you have a Thanksgiving, Christmas, so on and so forth. It's always the same thing. And this is why it's really useful, as I guess depending on how you trade, but overall it's really useful for your own knowledge as well, regardless of how you trade. So let's begin with metals. We have gold, copper, and silver, and I only include the metals that I have experience with, because all my videos, including this video, is only based on my knowledge and my experience. So there might be much more to it, but this is what I use. This is what I know to profit from selling options on futures. All right. So, and these are the only futures or the only metal commodities that I sell options on, or ever sold options on. So the metals really, they don't have any seasonality. They don't have any like recurring yearly events. Like the winter doesn't really affect much like the gold, the silver, or the copper. But and I guess this is in part because for gold specifically, it's more of a currency than a commodity. So gold, so there's more futures contracts for gold than there's actual gold like on Earth, or at least than there's actual physical gold at this moment. This is because essentially gold is just a currency. It reacts to geopolitical tensions, to the stock market itself. So it's not a commodity that is heavily used like silver and copper. And silver is actually used in many practical applications. But again, there's no seasonality for silver as well. It's nothing that you can kind of follow and predict in a way if the volatility will go up and down, because this is the only thing we care about with seasonality. We care about volatility. Is it likely to go up, or is it likely to kind of stay the same or even go down? Now, copper is an industrial metal. It's used heavily, essentially in every single domain, from electric vehicles to real estate to anything really. And China is the biggest consumer of copper. And I guess a few times a year, when China reports its finances and future plans for its economy, for its real estate, for the yen, this has effect on the copper, and it can affect the volatility of the copper. But at the same time, this is not really seasonality. It's more of a reporting of yearly reports that you can expect for to affect the copper. And for that, there will be a separate video specifically talking only about the reports or what reports affect each and every commodity and how. So for now, metals is something you don't have to worry about in terms of seasonality, and it's good to know, I guess, how each and every one is viewed currently by by traders all around. Now, currency futures. So as you can expect, they have no seasonality, and like the metals, we have the CPI, PC reports, and other like reports that can affect the volatility of currency futures. But again, this refers more to reports, which will be in a separate video. So let's continue on. So this is the more interesting stuff. So grains, we have corn, wheat, soybean oil, and soybean meal. Now, obviously, we have the winter or the winter harvest. So this is where you have a lot of volatility in the grains. Now, it's different. It's a bit different for each and one of them. And in a second, we'll go over an example. But usually from April to July, every single year, the volatility will increase. And prices can be volatile. Sometimes they're not. It really depends on the year, but volatility will always increase between April and July, because the winter harvest is being done for most of the grains in most parts of the world where there's a significant amount of export of these grains. Now, so if we take a look over here, I'll show you an example on corn. So if we take a look, so let's go as early as 2014, or I guess 2015 it will be, or let's see here. Yeah. So usually you have elevated volatility. It usually starts from April, but it really depends on the year, but usually it goes from April and all the way up to June, July, and then it kind of drops really sharply. But usually you have an increase towards April or towards May, and it goes all the way to July, and then just kind of goes down. See if we find a year where it's way more apparent. So this will be a perfect example. So you can see from April, it's gonna climbs up and up and up all the way to July. Then we have a big drop down, and it keeps on dropping. So it happens every single year. So it's really hard to kind of trade the commodity in certain ways, I guess. If you sell options, because when the volatility goes up, obviously when you sell options, it's kind of defeating the purpose of you selling the insurance on the commodity. So you can see the same thing over here from April. It goes up and up until July, and usually since July, well, at some point in July, it's gonna start coming down. So this happens basically every single year, every single time, and this is what I want to talk about when I talk about the winter harvest. Now, there's also a transition to the winter, so there's usually no significant volatility changes. Sometimes if there's really extreme cold, then yes, something might show up, and the way to follow is just to follow the news. So essentially, let's say for the winter harvest, I know approximately what time of year to expect it, but you have to follow the news. You essentially have to follow the reports every single morning, every single evening as well, and see what's going on. See the reporting that's being done on each and every, I guess, grain commodity or whichever one you plan to trade. Right? It's just a matter of following and reacting to what's happening based on how you trade. And for the winter, it's when we go, I guess, from summer to winter, It's the same kind of thing. If it's really, really, really cold, I mean like extreme cold, like not expected cold, then it might affect the volatility. But usually there's nothing significant that I've seen over almost 9 years now. Now from July to December, usually volatility decreases, as we saw over here. So usually from July to December, it kind of decreases, then it kind of goes flat, and then we have the same cycle beginning where the volatility goes up and up and up. So usually between July and December, it's a perfect time. It's a prime time for short strangles, I guess, not just strangles. And this is really where the bread and butter is for most, well, for me at least, for the grains. And from January to March, volatility can pick up. But it's usually pretty favorable for strangles as well, as you can see in this example from December, I guess, up until to almost the end of March. It's pretty flat for the most part. So you can kind of wait for a spike in volatility and go in, wait for a spike, go in, and you'll be doing just fine. Now let's go to the energy and the energy sector. So energy, we have natural gas and crude oil. So the winter for natural gas is a huge thing. So from around October and up to March, and again, it really depends on when the cold weather will pick up. Natural gas can become extremely volatile, and volatility is ramping up. And this is just due to the demand for heating during winter, right? Because in North America and in Europe, natural gas is being used as a primary source of heating, right? So there's a lot of demand, and like I said beforehand, anytime there's something with seasonality, something that has to do with a lot of demand, it can really skyrocket the volatility. So there's an increased demand, like there is with meats during Thanksgiving, for example, and the civil will go up. Now, crude oil is generally not really affected by winter, but volatility can increase here and there if there's extreme cold. So if there's an extreme reason for crude oil to something that can really affect the demand or the supply for crude oil, which is usually extreme cold, because then I guess machines and cars will be burning way more fuel, and then they will be needed. They'll need to fuel up way more often. So crude oil will be in higher demand, and it will be unexpected. Again, it's only if there will be extreme cold and it will be unexpected. So for natural gas, let's go just for an example to see what's going on from around October to March. So if we go to natural gas or nat gas right here. So currently, as you're watching it, I guess it's 2024, 2025. But as you can see, since October, we have just an increase in volatility. And, if you're watching it right as the video is out, you know how cold it is in parts of North America. It's extremely cold, and obviously you can see the volatility is being reflected. Now, if you go to the previous year, same thing you can see from October. Essentially, it's been going sideways for the entire summer, which is a talking point I'm going to go over in a second. But after that, I guess here from November, it kind of kept going up and up and up. And then usually as the cold dies down, the demand also goes down, and it's nothing too bad. So if you see over here, we have kind of the same thing. The demand is increasing and then decreasing towards the end of the winter. So again, it happens every year. It's nothing special, but the way I kind of use it is I don't really sell any strangles on natural gas during the winter months, and I follow the news, obviously, and I follow the weather conditions and the demand for natural gas, which is really important because there was I believe a fund that was managing $150 million, and they lost everything on natural gas just because there's a few reasons, but like a simple way for me to avoid this kind of loss is obviously having a stop loss, which they had, but they took it off. But also you don't they lost on a position where natural gas went down by 70%, the commodity itself, right? And it was winter time. because it was actually the previous winter in 2023, and it was not as cold as expected. So the demand was really not that high up, and the price just kind of tanked 70%, right? But you don't really know if the price will go up or down because weather can change. It's unpredictable. It can be extremely cold or hot. You only know after the fact, really. But what you do know is, again, volatility will increase because demand is never ever the same as expected, right? So it's always going to be more or less, and it will create volatility. Now, from March to September, crude oil is usually very flat, and it's perfect for strangles. And in some years, it goes the sideways trend continues into the winter. And natural gas is also goes sideways most of the summer due to the lack of demand and the predictability of a non-cold weather. So I guess in summertime, you can expect not to have cold weather, right? It's either going to be hot or really hot. And when it's hot, you only use AC, which uses electricity for the most part, or for most areas. So you don't really need natural gas. So I hope that you can see some kind of, I guess, like trend that's going in here. So if there's no demand, if there's if there's easy predictability for how the demand might go up or down or not move at all for the commodity, you'll be able to to tell if it's a good time to enter the market with a short strangle or not. And as you can see, let's see here. I think we looked at this year over here. So yeah, so usually like after April, as volatility goes down, as the winter kind of ends, the price really just goes all the way sideways until, in this case, I guess mid-November, and then it breaks kind of this formation here and keeps on going up as it gets colder and colder. Which this year, like I said, 2023, it was actually the opposite. It was way warmer than expected, and the price tanked by, I believe, 70%. Yeah. So the price tanked by 70%. So the dotted line is the underlying. So it's the price of natural gas. So it tanked by 70%, and then it actually increased quite a bit and tanked again. But the point is, volatility increased in the winter, and during the summer months usually goes sideways. The graph also usually goes sideways, and it's perfect for strangles. You just kind of need to pick your spots to enter with at least some volatility, and obviously enjoy the profit. So this is it, I guess, for natural gas and crude oil. Nothing too crazy, but again, it's all kind of the same things. And when you just do it over and over again, and you look at the news over and over again, you can also know when to look for stuff, right? So natural gas, crude oil, you would look for news like closer to October, when the winter is in effect, basically. So let's talk about meats, which is essentially the last commodity that we have. So we have lean hogs and live cattle. Now, in winter, and this is a funny one, I just found out about it recently, but during extreme cold, livestock burns more energy to keep itself warm, and therefore it will become leaner, and this can affect the supply. So essentially, each cow or each pig or each hog, I guess, they'll just have less meat on them because they burn more calories to be able to, or more energy to be able to warm themselves up. And volatility can actually increase significantly because of it. And as you can imagine, it doesn't happen often where there's extreme cold to a point where this is actually a concern. But it does happen, and again, you just follow the news, right? So you don't have to predict anything. You just need to react to what's happening, and decide if you want to take on the risk to put on a trade in a certain way or not, right? This is just to aid you to make the decision, a better decision. Now the holidays are, again, very, very simple. So we have Thanksgiving. Oops, I'm missing a Thanksgiving. I'm missing a G here, but it's okay. So Thanksgiving, Christmas, and then I guess what other holidays people tend to buy a lot of meat. I'm not sure, but usually in the holiday season, there's more meat consumption, there's more family meals, so on and so forth. So consumers just purchase way more meat, and therefore the demand increases, and this causes volatility, right? So again, demand increases. We can see that the demand can fluctuate in an unpredictable way because it's Thanksgiving, Christmas, whatever the reason is. It's pretty clear that people will buy more meat, people will make meals. It's not something that can easily just change or not happen, right? And the demand can be essentially changed or affected by an unpredictable way, and this will cause volatility to go up. So if we expect volatility to go up, we don't sell options. I don't know if we buy options. I don't buy options, but overall, if I expect volatility to go up, I really don't want to touch the commodity. I just want to just kind of wait and see for something to happen, and then maybe react to it. And maybe when volatility is really high, maybe I can go in there and sell a call or sell a put for a really, really high price, have a really good stop loss, and then when volatility eventually goes down, just gonna profit off of it and off of theta. And this is basically what I do in a nutshell, with strangles, with short calls and short puts. Now, there's one more thing that I guess livestock count, which can affect the volatility for the meats. But again, this refers to reports, like I said, with the metals and the currency futures. And this will be in a separate video where we will talk all about reports. But this is basically it for this video. I hope it was really, really helpful. And for me, all this data, all this knowledge, just gonna help me either avoid a lot of losers or just take advantage of really, really, really good situations during the seasonality for each and different product. So this is it for this video. If you have any questions, please let me know, and I will catch you in the next one.